I think we're going to enter a bear market that people are going to remember for a long period of time. I think it's likely to be one that, will make its mark on the charts.
All right. A bear market is a decline of 20% or so from our highs at a minimum.
I think it's going to be quite a bit larger than that.
What do you see? What do your charts tell you?
Yeah, I would say at least as bad a bear market as 07 to 09, at the very least.
Does it ever get nosebleedy for you, or do you find that all these levels, multiples, are justified?
Yeah, it feels a little nosebleedy to me, Neil. It really does.
All right, Steve Ballmer and Peter Elides and Robert Prechter, all names of concern that we're getting a little too rich for our britches here, and that comeuppance is in order. To Barron's.com editor Jack Otter, what he makes of that. Lo and behold, Jack, today we have the news with GE and the dividend slashed in half. The stock is still tanking. Is this the preview to coming attractions? What do you think?
Well, first, I do have to do a quick back pat. For readers of Barron's, it was no surprise that GE slashed its dividends. We warned them.
You did indeed, by the way.
I think it is very, very dangerous to listen to people who tell you that the market is going to plummet or going to soar. One of them is going to be right.
Right.
But we just don't know whether the bears, the bulls are right.
Like a broken clock, someone eventually is right.
Someone is eventually
but
right.
You could argue that after almost 9 years, we're due.
Yes, certainly this bull market, is getting long in the tooth, and what that means is you've done well if you've been fully invested, and now is the time to look. And don't think in terms of percentages, because those are harder to chew on.
Right.
Whatever you've got, 10 grand, $1 million. Imagine if that was cut in half. And how could you sleep at night? And if not, it's time to diversify a little bit. Bonds, maybe some safer stocks, maybe some alternative investments. Do it now while the get going is good, rather than waiting until things really fall apart.
Barron's is known for calling bubbles and being ahead of stocks that everyone loves and thinking about them. GE is a very good example of that, where you've been sort of telegraphing this dividend move, but it's been horrific, the fallout, and I'm wondering what that says about what used to be safe investments, where a lot of people, even when a stock slid to smithereens, this is a little extreme what's going on, G, you had the protection of income, and now you don't even have that.
Sure. So a couple of things. One, I think GE is largely a stock-specific story. We could go on and on about the problems with that company, but you look at a Honeywell, does much the same thing, a little bit smaller, less well-known, and that's
Remember when they were looking to hook
stock.
up?
Yeah, exactly.
Yeah,
but that's been a wonderful stock over the years.
Do you worry when someone like the new CEO, Flannery, says, I don't really obsess about that sort of thing, the stock price and all. Now, he's attaching
He has to say that.
salaries and all that to the stock, so obviously it does matter.
Sure.
But it's not mattering today.
Yeah, but I really think, again, it's a stock-specific story. There's a lot of financial engineering that went on that company for decades, and they got away with it, and now they're paying for it. You have to think a breakup might very well be likely.
But it used to be like investing in GE was like investing in a growth mutual fund.
Right. And
the days of Jack Welch.
And this is a great warning for people not to fall in love with the stock. And there is no such thing as a single safe stock. Right now it's the FANGs, right? And everybody who bet on them has been doing wonderfully. At some point,
the
that
Facebook,
music,
the Apple, and Netscape, right?
And that music is going to come to an end.
So don't fall in love with one issue. What's the issue that should telegraph concern for you? I mean, a lot of people are disproportionately invested in those stocks.
Right, and so now is the time to take some of your winnings off the table.
Really?
Absolutely. I'm not saying, I could sit here a year from now and they could be up another 25%, and you'd say, Jack, why'd you tell them to do that? And the reason is because I don't know, and at some point things will stop. But now is the time to look for what is cheap. Is there anything out there that's cheap? So the Barron's covered this week, we recommended automobile stocks. And because,
I thought you had all gone drinking for that issue.
Right, exactly. So people are going to say you're crazy. Journalists don't drink. Come on. GM is a mess, right? It's all going to be electric soon.
But maybe they're beaten down for a reason.
They are. They're not perfect, but they're selling at 5 and 6 and 7 times earnings. And I would rather own that kind of an issue at 9 years into a bull market than a stock selling for 20 or 30 times. And, the old defensive stocks, it's not just GE, but if you look at consumer staples, I mean, the toilet paper and the peanut butter that everyone says, well, even in a recession, people will buy those things. Those stocks are selling at 20, 22 times earnings.
Is that right?
So that's why suddenly autos look good. But there's also lots of other value stocks that have been ignored because they haven't shown this great growth of the FANGs. Lincoln Financial is a very boring insurance company, it's selling about 11 times. So you can buy a value index or go with a good value manager, and that'll protect you. And I've
What
got
about
one,
people who like the allure? Now, a lot more tech companies are doing this, Apple, Microsoft, and all, that have dividends and all, but that is their sole strategy. I want to have a lot of shares in a lot of stocks that pay me even a little bit of money, but it adds up. Their whole people have strategies like that, ignorant of the price. What do you think?
well, exactly. And the problem is that yields have been so low for so long that these are so-called bond proxies. Well, I'm getting better income from that
Absolutely.
stock than I would be from the 10-year bond. And that's true and that's fine, but even they are kind of expensive. Usually, if a stock had a juicy yield, it meant it was cheap. Now it doesn't always mean that. But again, you can go shopping in, say, telecoms, which have been beaten down recently, as you say, for a reason.
Right.
But again, when the market, good example, when the tech bubble burst, obviously, the tech stocks plummeted. You would think that in that awful market, looking back, everything fell, but it didn't. The hated stocks, the Philip Morrises and others, actually went up. Small caps were not loved at all. Those went up during that time period. So you can diversify away some of the pain.
So real quickly, the big macros right now seems to be the prospect for tax cuts. I've argued that Roy Moore's situation has actually sped up the timetable Republicans want to get these things done long before the December 12th Alabama election, whether that is a factor or not. Do you think that the optimism the markets have about the bang for the buck they're going to get out of these cuts is justified?
Well, now I'm not sure that the markets are terribly optimistic. If you look at how last week stocks performed,
Absolutely.
the small caps, which were supposed to benefit more from the tax cut, did worse than the big caps.
So is that sensing that these don't happen, or if they do, it won't be a big deal, or we've already enjoyed the run that we're going to get?
I think it's a combination of we've already enjoyed the run in the expectation it would happen, and now the market's saying maybe it won't happen, maybe we better pull back a little bit. And that suggests that if it does happen, maybe you do get a little bit of a bounce.
Wow. All right. Jack, thank you very much. Jack Otter, thebarron's.com editor. So